Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 6th of July. I'm Daniel Lam, your host for the podcast. Given the surprisingly hawkish Fed meeting last month, it is worth checking the minutes from the June FOMC meeting. Now recall that the most notable development from the last meeting was an upward revision to the Fed's 2023 interest rate projections, with the median now calling for 2 more 25 bips rate hikes this year. Looking at the minutes, it did explicitly say that some participants would have preferred a 25 basis point rate hike instead of a pause at the last meeting. The minutes made several references to very tight labor markets and the fact that core inflation hasn't shown much evidence of a sustained easing since the beginning of the year. Ultimately, the number of rate hikes remaining in this tightening cycle will be determined by the resilience of the US labor market and how quickly core inflation recedes. Hence, from a macro perspective, there is extra importance to this Friday's NFP and next week US CPI release. And from the investment's perspective, we need to ask ourselves, will we be getting a no-landing scenario in the strong US economy, or do we get Fed over-tightening? It's worth noting that over the last few sessions, the US 10-year yield has been edging up, and it is now getting close to the resistance level at 4%. This hawkish Fed narrative appears to be sinking into asset prices. Like we discussed earlier this week, there is a risk of over-tightening. Therefore, make sure that there are stabilizers in your portfolio, such as gold, which was what we discussed earlier this week, and focus upon high-quality bonds, which is likely to benefit from any pullbacks in yields that may occur from potential rate cuts in 2024, when the US economy is likely to enter recession. Now, how about equities? Well, history shows us that US technology stocks performed well during periods of rising recession probability, giving slightly over 30% annualized returns, before giving up some gains when recession hit. Now, if you look at the chart of Nasdaq 100, it is approaching the key resistance at 15,265. So at this moment in time, there seems to be more value adding to DM high-quality bonds, while more attractive opportunities may lie ahead for investors in US technology stocks when Nasdaq 100 pulls back to around, say, the 14,500 level. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.